Welcome to vTalkInsight, Risk Sentiment Daily for March 10th, 2026. An historic Middle East energy shock is colliding with a sharp rise in global bond yields, testing traditional safe havens and forcing a rethink of portfolio risk. Let's start with how today's overall risk tone is shaping up across assets. Risk sentiment today is decisively risk-off. Even though headline U.S. indices have managed a modest bounce and the volatility index has eased back into the mid-20s. Under the surface, equity markets are still digesting one of the fastest oil price spikes in decades, while both stocks and bonds face simultaneous pressure from higher inflation expectations. The macro narrative is now firmly anchored around the Middle East energy shock and its stagflationary fallout. Crude has surged above $100 and, at times, pushed toward $120. Natural gas prices have jumped, and supply routes through the Strait of Hormuz and surrounding waterways are severely disrupted, leaving energy importers and cyclical sectors under sustained stress. Against that backdrop, investors are de-risking, rotating toward energy, value, and higher quality balance sheets, while trimming exposure to small caps, rate-sensitive areas, and regions most exposed to imported energy. At the same time, persistent retail allocations to equities, ongoing interest in AI and secular growth, and relative resilience in U.S. large caps show that risk appetite is bruised, not broken, keeping the tape choppy but skewed to defense. The central bearish driver is the Middle East energy shock and stagflation risk. Closure of the Strait of Hormuz, drone and missile threats to tankers, and forced output cuts from major Gulf producers have created a disruption larger than the 2022 episode, with futures curves in steep backwardation and time spreads at record levels, signaling extreme tightness. Oil has jumped more than 12%, with Brent moving from the low 70s to well above $100, and at points nearing $120, while about a fifth of traded natural gas is offline. Higher crude and refined product prices are already lifting gasoline and diesel costs, with several analyses flagging $4 pump prices in the United States and warning that sustained triple-digit crude could shave more than a full percentage point off global growth and reverse recent disinflation trends. This energy shock bites through multiple channels. Earnings forecasts for 2026 and 2027 still assume roughly 14% annual growth and solid global GDP, yet weaker job creation, softer household balance sheets, and higher fuel costs all challenge that optimism. Consumer-facing sectors such as airlines, cruise lines, and transportation are already in correction or bear market territory, and strategists highlight that a prolonged period of elevated oil would likely be needed to trigger true demand destruction and a deeper equity drawdown. Even if prices retreat from recent peaks, many expect a lasting risk premium in crude and gas because infrastructure has been damaged, restarts take weeks or months, and Iran and its proxies retain the ability to disrupt shipping. The key watch points now are how long the disruption lasts, whether G7 reserve releases can smooth the shock, and how quickly higher energy costs start to show up in inflation data and corporate guidance. Layered on top of the energy shock is rate hike repricing and a powerful yield shock, especially in Europe and the UK. Markets are now pricing in 2 rate increases from the European Central Bank this year and assigning more than even odds to a Bank of England hike, a stark shift from expectations of cuts only a few weeks ago. Government bond yields are jumping across the curve. UK short-dated yields are up more than 20 basis points. German and broader European yields are rising sharply, and U.S. Treasuries have also backed up as inflation concerns eclipse earlier focus on labor softness. Financial conditions are tightening even before central banks move, with higher discount rates pressuring equity valuations and making life harder for indebted borrowers. This creates a striking policy divergence. The Federal Reserve is widely expected to stay on hold into mid-year, while Europe and the UK are repricing toward further tightening, reflecting their greater sensitivity to energy-driven inflation and the ECB's single inflation mandate. For assets, the combination of higher real yields and elevated volatility means a tougher environment for rate-sensitive equities, long-duration growth names, and regions that rely on cheap external funding, even as longer-term inflation expectations remain broadly anchored. The third major headwind is growing market fragility, liquidity risk, and emerging credit stress. Equity volatility has spiked above 30 at times, and while headline indices are not far from recent highs, breadth is deteriorating, with more sectors rolling over and technical indicators suggesting room for further downside before any true capitulation. Positioning adds to that vulnerability. Retail allocations to U.S. equities remain near records. Institutional mutual fund cash balances are at historic lows, and exposure is heavily concentrated in S&P 500 index vehicles and private equity. Crowded holdings in mega-cap growth and AI leaders are now seeing sharper pullbacks, as illustrated by sizable declines in names like ASML, showing how quickly liquidity can evaporate when positioning is one-sided. At the same time, cracks are appearing in credit and private markets, with high redemption pressures at major private credit platforms and concerns that many loans sit on highly leveraged borrowers who lack access to traditional bank financing. Bank-specific worries are also surfacing, with downgrades tied to exposures to troubled borrowers and failed lenders, adding to unease that a funding shock or forced selling could amplify equity volatility if the macro backdrop deteriorates further. Set against those headwinds, one of the clearer supportive forces is the emergence of energy and the dollar as beneficiaries of the disruption. Triple-digit crude and the closure of key shipping lanes have driven strong performance in U.S. and European oil majors, with companies such as Chevron, Exxon, BP, and Total substantially outperforming broader equity indices as investors rotate into perceived stagflation hedges. U.S. non-OPEC production growth is also acting as a partial buffer, with surging demand for American exports pushing West Texas Intermediate to trade in line with Brent and highlighting the United States' shift toward energy exporter status. That dynamic, together with high global inventories outside the official strategic reserve system, offers some cushion against the most extreme oil spike scenarios, even if it cannot fully neutralize the shock. In currencies, traditional havens like bonds, the yen and the Swiss franc are proving less reliable, leaving the U.S. dollar as the primary beneficiary of the flight to safety and of America's energy advantages. Positioning has swung rapidly from near-record short dollar exposure to renewed demand, underscoring how this environment favors energy exporters and dollar assets over energy importing regions and riskier equity segments. Another constructive thread is AI and secular growth resilience. Despite the macro headwinds, leading technology firms continue to plan more than 30% growth in AI-related capital expenditure, reflecting multi-year commitments to infrastructure, software, and data center build-outs that are not easily reversed. There are also signs of ongoing appetite for AI exposure. Chinese software stocks have rallied on the back of viral domestic AI applications, and some high-profile investors have materially increased stakes in flagship AI names such as NVIDIA in an effort to underpin confidence during the sell-off. These moves point to a belief that the earnings power tied to AI and productivity gains can help offset some of the macro drag. That said, the picture is not one-sided. The nearly 5% drop in ASML and broad selling in crowded megacap growth show that even high-quality AI-exposed franchises are vulnerable to higher discount rates and position unwinds. The key question for portfolios is whether earnings revisions in these secular growth areas can stay positive as growth slows and financing costs rise, or whether valuation and liquidity pressures will ultimately dominate. The final supportive driver is the role of U.S. large-cap quality as a relative haven. Despite multiple shocks from energy, payrolls, and private credit, U.S. equities are down only modestly from recent highs, with large caps holding up better than small caps as investors lean into balance sheet strength, cash generation, and global diversification. Many asset managers are concentrating on companies with robust free cash flow and resilient demand, often in industrials, materials, and healthcare, while maintaining selective exposure to secular growth themes. This quality tilt, combined with earlier de-risked positioning, is helping U.S. large caps function as an anchor within multi-asset portfolios even as volatility remains elevated. The risk, however, is complacency. Valuations for many U.S. leaders remain elevated, earnings estimates have not yet adjusted meaningfully to the new energy and rate backdrop, and mutual fund cash levels leave limited dry powder to buy a deeper dip. Monitoring earnings guidance, sector-level breadth, and whether large-cap leadership persists or finally cracks will be critical for gauging whether the current defensive resilience can be sustained. To sum up, today's backdrop is one of decisive risk aversion driven by a severe Middle East energy shock, a sharp repricing higher in global yields, and mounting concerns around liquidity and credit, even as U.S. large caps, energy, the dollar, and selected AI and quality growth stories offer pockets of resilience. The balance of risks remains skewed towards stagflation and tighter financial conditions, so the path of oil prices, incoming inflation data, and any further signs of stress in credit and funding markets will be central to how risk premia evolve from here. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.